Welcome to Fear and Greed, the week ahead. Back with us this morning is resident economist Stephen Koukoulas. You'll find him at thekouk.com and on Twitter using the handle thekouk. That's THEKOUK. Stephen, good morning.
Good morning, Sean.
You must be exhausted after all that economic news last week.
There was lots. Well, we had the RBA board meeting. We had a very important speech from the RBA Governor, Philip Lowe, at the press club, and we had the quarterly statement on monetary policy. So it was a real, in a sense, recasting on what the people who pull the trigger on interest rates are thinking, the Reserve Bank. And we had a run of news on things like the international trade balance, which was still pretty hefty, building approvals, which was surprisingly strong. So it was a lot to digest.
Now, one thing, we'll get into the details of some of the Reserve Bank stuff shortly, but what I did like, when anyone ends up at the National Press Club, it happened with Scott Morrison a couple of weeks ago, Philip Lowe last week, when you get journalists asking questions, they're just a little less polite, I think, than market economists or bureaucrats. So you kind of tend to get to the nitty-gritty stuff. Would you agree?
They cut to the chase, yes. And I thought, and this is something that I think Phil Lowe's developed in the last 6 to 12 months, as he's been open to a lot more Q&A from market economists and journos, including at the press club last week, that his answers and his discussion of points when he's verbalising them is much better than reading the written statement, if you like. You can drill in and sort of scratch the surface a bit. And I must say that if he had more of that, what do we call it, a bit more of an open, relaxed idea and talking about the risk. You know, he's acknowledging, as all economists should do, that, you know, he doesn't know all of the answers. And when he talks about the risks, he's very informative.
Yeah. I mean, that's what I did think about. I mean, Philip Lowe is obviously a very, very smart economist.
Oh, indeed. Yeah.
He knows his stuff really well. So when he actually is in front of the media like that, or market economists, it's not that anyone is ever going to trick him. And he's kind of humble enough to actually just say, look, we don't know about that. And that's kind of good.
Yeah, and here's our forecaster, here's our central case, but we acknowledge there are risks to it. And in fact, he started his speech last week with a table saying, well, this is what we said a year ago, and this is actually what happened. And of course, they were wrong, and that's not a criticism. But as he was saying he was wrong, we've been wrong. But the economic news has been materially better than we were assuming. So let's celebrate the good news.
So what did they say? I mean, what do we know now that we didn't know a week ago?
Yeah, well, we know that the Reserve Bank has acknowledged that inflation is considerably higher than it was assuming. We know that they're acknowledging that the unemployment rate is lower than they were assuming or forecasting, and that the labour market is still very tight. But what they did say was put a little bit of a flesh on this discussion about, you know, imminent rate hikes, and they're not imminent, according to Dr. Lowe, that the RBA's of the view that the Omicron variant might just cause a little bit of a bump in the road for the economy in the next month or two in terms of the hard economic data for January and February, when we eventually get that, and that they can afford to wait. So the expectations for rate hikes, which were building to the middle of this year for the first hike, have now been pushed back to the latter part of this year. So there's still rate hikes priced into the market, and Dr. Lowe acknowledged that, but they're not happening anytime soon.
It seems like the smart money is on very late this year or the first half of next year.
It seems to be around about that. Yeah, when I see some of the market economists who are good at forecasting monetary policy from the RBA, the Bill Evanses from Westpac and the team from CBA, they're sort of suggesting August, September-ish as the first hike, and maybe one or two in the final months of 2022. So that's sort of reflecting what the market's now pricing in as well. So if we look at the futures strip, they've got the cash rate ending this year just a little under 1%. So 90 basis points, if you like, of interest rate hikes by the end of 2022.
Okay, that was last week. We'll be back in a moment and get into the week ahead. Now, Stephen, there was other details out last week around trade, as you mentioned, and house prices and credit data and that. What have we got this week?
This week's pretty good. We've got the retail sales numbers, which is sort of the final version of the preliminary numbers that were released recently. And we know that in December, as Omicron started hitting around Christmas time, that people did hunker down. So retail sales probably down around about 4% for the month. So that's not to be unexpected, but that, it should be said, followed a couple of months of very strong growth, including with the, what are they called? The Black Friday sales, which are at the end of November, yeah. Sorry. So we've got some volatility in the retail sales. We've also got job ads. Demand for labour still seems to be very strong. And we've got the really important really important, NAB business survey and the consumer sentiment numbers from Westpac. So how are we consumers responding to the virus and low interest rates and the volatility in the stock market and things like that? And of course, business, what are their plans for hiring, for CapEx, and for just their general optimism about the economy?
So really, there's plenty of things, the NAB business survey, job ads around the labour market, which of course remain central to what we're talking about earlier on and when the Reserve Bank does anything on rates.
Indeed, and that's what Dr. Lowe was talking about last week in all of his various commentary, that it is labour costs that are the critical issue for them when it comes to being confident that inflation is going to be, well within the target band for an extended period of time and before they trigger rate hikes. So the labour cost argument, of course, with the tightening in the labour market is really, really the fundamental point. And if we look at just where the ANZ job ads are coming from, where the update will come later this week, it's from a really strong base. The demand for labour is running rampant, I think it's fair to say, that, and that 4.2% unemployment rate that we saw a couple of weeks ago for the month of December. Again, Dr. Lowe, and I think most economists now are forecasting that if the job ads continue to grow, that the economy continues to expand at a pretty decent pace, we're going to have unemployment below 4% for the first time in almost 50 years. It's an extraordinary time.
One thing he did say last week, which I thought was interesting, he was asked directly by one of the journalists whether immigration played a role or the lack of immigration played a role in the jobs market. And he basically said, look, it's about fiscal and monetary policy more so. That does mean, though, that, fiscal and monetary policy, when they tighten, and the Reserve Bank has started that, albeit not with rates, fiscal policy, Josh Frydenberg has said he can't just keep handing out money. That will do something to the labour market.
It will. Certainly the slight tightening in fiscal policy and the prospective tightening in monetary policy, we know they're about to end their bond buying program. In fact, later this week on the 10th of February. So they're starting to position themselves for less easy policy, let's call it that. And that will have the desired effect of cooling the economy down. And don't forget, they're only doing it because the economy is improving. So while the labour market is running rampant and we're heading for a sub 4% unemployment rate, what comes with that is a probable lift in labour costs, and with that is a probable sustained increase in inflation. And as we were just saying, the RBA want to see it not move from a probable to an actual, because they don't want to hike rates prematurely and find that in 6 and 9 months, we probably shouldn't have hiked. That's their thinking at the moment, even though we know around the world that, the Bank of England, the RBNZ, the Fed, even the ECB last week, the European Central Bank, were talking the possibility, Christine Lagarde, the possibility of rate hikes in the Eurozone, which is something, that really spooked the markets.
Stephen, have a great week.
Thank you, Sean.
That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.